The market, welcome back, is above yesterday's high. It's basically made a new high for the day. So that's interesting. And 18,333. The push, I think, is coming from banks. The bank Nifty will come up. And the HDFC twins, HDFC Bank and HDFC, between them are adding about 20 index points to what the Nifty is doing. Actually, it's a combination of banks and IT. So HDFC, HDFC Bank and ICICI Bank. Three of them. And then there is Infosys and TCS. Which is the other leg, which is adding about 15 points or so to the index move that we are seeing. So will this be the push which finally clears the zone? I think we'll have to kind of wait and watch. At the broad level on the upside, I mean, first you've got to stay above this level, the opening level, and then, I mean, 18,400, etc. comes into view. Quest Corp is the next company as promised, which is in focus. Quest Corp, even as the market has done well, relatively and in some senses in an absolute way as well, has not done. The stock Quest Corp is down some 50% this year. The company's job platform, Monster, has transformed to an end-to-end talent management platform. Founded.in, it will be known as Founded.in in Asia Pacific and West Asia. To discuss more on this and generally what is business looking like really, Ajit Isaac, chairman of the company, is now joining us to take some questions. Mr. Isaac, great to have you with us here. Thank you very much. Appreciate it. Could you tell us a little bit about this sort of transformation, rebranding? How is this? Why have you done this now? And, how much will this help really? Because, I mean, there is a big gap between the number one player, which is Naukri, and where Monster is at in the same segment that you guys operate in. Take it away, sir.
Sure. So to give you a kind of historical background, we acquired Monster in 2018, and then the first 18 months or so was spent in managing the transition from the previous owners to us and in reorganizing the technology backend. In 2020, we had COVID, and it was in that phase that we hired new leadership. We got new product specialists on board and started drawing the roadmap for a new product journey for Monster, which has now come to the finish point. And we've launched the new product. So the branding itself is to symbolize the new product that we've got, is to bring to the market a differentiated position from what it was in the past, and to give it a new lease of life in the market. We've had some terrific response to the product. Our traffic's gone up. This year, our revenues are expected to go up by about 70% year on year over the previous year. So we're seeing great traction, and we are slowly getting more market share. We're here for the long term. And we think that we will acquire a significant space in the job board market as we move along.
Okay, Mr. Isaac, good morning. I wanted to ask you about your own, way forward in the company, because I understand that you have been buying stake in the open market. What's the reason for that, and how much does it stand at? And would you want to sort of get back to that 55% stake that you had about 2 years ago?
Well, so, we've had two situations since we listed when our stock price fell. One was when COVID happened, and, we dropped, to a low of about 160, and then that was the time when I bought a bit. And even now, I think the fall is unreasonable. It does not really reflect the value of the company, and that's why I've been buying a bit. As a promoter, I'm happy to enhance it as much as I can. And the position of the company in terms of its results for the future, I have a confidence about it. So I think, I will do as much as I can to increase my stake in the company.
At current levels, you're a buyer. At current prices, you're a buyer, sir.
Absolutely, yeah.
Okay. And you don't have any targeted holding as of now, but you're saying that, you believe that the stock price is undervalued, so you look to chip in as and when you can. We get that point. Just to get on to the previous point about Monster's market share, in comparison to Naukri, what is the updated number? If you could just give us a broad sense. And you're saying that there is potential out here, so you must be having a targeted market share number.
So, it's a bit early to work with the market share. I think there are two things happening. One is the market itself is changing a bit because of the slowdown in the IT hiring space. So I think we have to see how that pans out for all the players in the market. Second is, our platform is a little different from what it was in the past. Previously, we had, like our competitors, we had a discover-only platform where you keyed in searches and you got results. This time around, we have more personalization. If you and me search for MBA candidates on our site, it's more likely that we will get slightly differentiated results because of the way the algorithms analyzing who the user is. So we think these are changes that will come to play. We don't have a target right now on the market share, but we are looking at traffic, and that traffic is, we are seeing significant changes in traffic. The last month has been one of the highest increases in traffic for us.
Mr. Isaac, you mentioned 70% growth in revenue year on year. That is for Monster.
Monster, that's right.
For Monster, yeah. Okay. We'll ask you to put out, a guidance for the full company as well, and you're welcome to do that. But just one point, what is the proportion of variable pay versus fixed pay contracts in this part of the business, workforce management?
So our collective pay is close to about 75% today. So only about a quarter of our business is what we upfront pay. So, and in our staffing, in our professional staffing business, it is entirely on a back-to-back contract with our clients, where we pay salaries on the basis of what we've agreed with our clients. So there's no variability in that sense.
So, just to understand the hiring, right? Because there are many other companies that have indicated to us that hiring has slowed down in a big way. Do you expect this slowdown to continue? And if yes, do you think it could put more pressure on not just your overall business, but on your margins as well in the second half of the year?
So that's a good question. IT, I think for the next 2 quarters, is not going to see a turnaround very easily. And from all indications, it's going to stay flat. Having said that, there are certain pockets in IT which are still seeing renewed demand. For example, in areas like DevOps, cybersecurity, in the area of big data and digital processes, we're still seeing a lot of requirements. We're also seeing global development centers that are set up for offshoring of back office process of companies still hiring in India. And that process could pick up through a recession, through a possible recession in the US, because US companies will want to reduce costs. So I don't expect the IT business to turn around very quickly, but the rest of our business, and IT constitutes, we will do maybe about 50 crores of EBITDA from our IT staffing business out of a total of maybe around 600 odd. So I think it's 10% of our overall numbers. So I'm not unduly worried, because in a 15-year time span, we've seen at least 2 or 3 instances when we've gone through such cyclical movements. And it will settle down another, let's say, 6 months to 8 months time, and then we should ride the upwave again.
The reason I'm also asking is because, some of it is reflecting in your stock price. The stock is down almost 25% in the last 1 month. Of course, that's not for you to assess why it's happening, but there are some concerns, right? And perhaps on operational performance as well. Do you think your margins could get hit further? And if yes, from this 3.2% mark that you hit in Q2, what could be the trajectory in the second half of the year?
So I think our key issue is our IDC. We have to reduce our IDC. Our costs have to come down. We have to reduce by about 20% per month. And that is an exercise that's ongoing right now, one. Second is we have to continue our pace of growth. We've been growing by about 5 to 7% every quarter. And that we have to sustain either by top line growth or by a product mix that's changing that will add more margins to the company. We've come to 3.2. Our first target is to get to about 3.5%. Once we stabilize at 3.5%, then I think we'll go upwards from there. Our stated goal in our company is to look at a 20% ROE. So a margin improvement is important, but even if margins don't expand significantly, if the EBITDA that's reported helps us to get to a 20% ROE, then I think we've reached the greater goal that's there now at Quest.
Mr. Isaac, briefly, by when will Monster turn profitable, sir?
So Monster will need another year to get market share and to turn profitable. I think it will burn some cash next year, but it will exit the next financial year on a cash neutral basis. And then from there onwards, we'll make money.
Good speaking to you, Mr. Isaac. Thanks so much for stopping by. Wish you all the best for the second half of the year, and look forward to chatting up with you maybe in the new year. Well, let's move on then. The next corporate we're speaking to today is Fino Payments Bank. Remember, the stock was buzzing and trade was locked upper circuit, 20%. It's up closer around 10%, I think, even today. Mr. Ketan Merchant, the CFO at Fino Payments, joins us. Hi, Mr. Merchant. Good morning. Thanks so much for speaking to us. Well, yesterday there was a large trade that took place, and now we know the buyers, Capri Global Holdings. Well, that's part of a listed entity as well, Capri Global Capital. Could you tell us is there any more to the eye than what we should be looking at? Are you looking at any kind of strategic partnership? And just to clarify, it appears there is some overlap between both your businesses, what you're doing and what Capri Global does. Please clarify on both these 2 points.
Yeah, thanks, Prashant. Hi. For us, what we are into payments bank, we are into distribution. We have had a network and wherein we cannot lend. So they are into a lending kind of a business, as all of us know. For us, partnership is something which we keep on looking, irrespective of investment. Other aspect which I would want to say is the kind of results which we have shown. We've had 117% growth which has happened in bottom line in H1 YOY and 32% growth in the top line as well. So from a value perspective, and our intention also is from long-term perspective, we can do a lot of things in terms of the payment bank space as well. So as I would say, from a deal perspective, there is nothing specific, which we can look at and stuff. But from our performance and our positioning perspective, I think we are geared for long bets coming off and long growth and opportunity exist. So that's where.
And is there a possibility of some strategic alliance between both of you?
No, I think at current stage there is nothing like that which we are exploring it off. There can be synergies, and there can be synergies in all financial services partnership. That's always a possibility. But as things stand today, it is more in terms of our business performance, which is in our view driving our growth as well.
Ketan, sorry, cross ownership can increase those synergies. You would agree, right? That's why we are pressing on that point. So nothing, something in the future possible?
Yeah, as I said, currently there is nothing on the cards, in terms of what we are just speaking about. In future, whether it's this or anything else, things can come out. But currently, as we speak, it is more about our business and our potential. Maybe that's what perhaps the aspect which is being looked at.
Okay, Ketan, sorry, I have a very basic question, which many of our viewers would also have. Could you just break up the the income lines for our viewers? Which are the big income lines, and how is that split? What's the split for you at this stage?
Yeah, that's a fair question. I think I've said it earlier as well. For us, we are a very differentiated payment bank, or we are a differentiated player. Whilst we are a bank, we run on a very asset-light kind of a model. If I just bifurcate our revenue pie, 1/3 or slightly more than 1/3 comes from remittance business. Approximately 16% comes from our liability CASA subscription-based business. 8% comes from our CMS business, and around 21% is coming from our cash withdrawal business. And there is a 8-9% treasury income also, which we essentially get through. So I think the USP which we believe we carrying are the asset-light model, a high ROE potential, and a massive opportunity. Currently, we have around 59 lakhs plus accounts. Our target can be, as high as 60-70 crores kind of a Bharat population. The population, that's where we can aim at.
Okay, just coming back to the point that you earlier made about you're not looking at any strategic alliance at the moment. Just to understand, Capri Global Holding bought some shares and they are, in a sense, competitors with you at some level, right? So where does that leave you now?
No, it is. I don't think we have any competition between the two of us. We are completely into a payment space. We are completely into a network space. And my understanding of Capri is that they are into lending. And so there can be synergies, but I do not see any competition happening. The point to reckon out here is in our payment space, we anyway look at loan referral as well, wherein we leverage our network, and we have partnerships with NBFCs for them to lend. So from a competition perspective, understanding is that both are mutually exclusive business. One is lending, the other one is payment space. Okay, all right, Ketan, have you spoken to the management of Capri Global though? Any discussion? No, the point is we've not had a specific one-on-one chat, etc. But however, what essentially happens is we have our discussions, meetings in some conferences, and maybe some analyst or some part of their members could have been hearing our roadshows or our. But you haven't directly spoken to them, is what you're saying. Is that correct? Have they said any intent that they want to buy more stock? 30% in 2 days the stock moves up. The street is smelling something. Now we'll have to find out what that is. Have you heard from them? I agree on that. I agree on that the stock movement is quite steep. Maybe they are finding a strategic position, or they are taking a strategic position wherein they're seeing a value coming out in times to come. So that's how maybe they can be looking at.
Just a quick point. One, I understand that what you call open banking, right, as compared to own channel, open banking margins are very low. Own channel, of course, are very, very high. And open banking is about 38%, 40% of your revenue. So you want that to go down and own banking to go up. Can you just explain that point and how will that happen?
Yeah, I think that's a fair point. Just to give a perspective to the numbers, it is in the range of 64 and 36 for the last quarter. The reason is open banking is where we give our banking APIs to other fintechs, and they can travel, they can do transactions on our platforms. Our genesis is currently, whether it's liability generation, our key products, which are key growth products, which is grown by 100% and like 80%, in terms of CASA and CMS, those are on our own channel. So an own channel which carries high margin. Both of these products carry margin of 58% and 41%. So that's where we essentially looking at growth. And as we've said, we've given guidance that we'll try and keep it in the range of 67-33, 2/3 our own and 1/3 in terms of our open. There are a lot of value which open also brings in terms of the future leveraging, which we can essentially do on the open banking as well.
Okay, got that. Just one final question. In your conference call, you mentioned that you have plans to merge with your parent entity. By when will that happen?
So that is a process, how the merger essentially happens. So we've completed 5 years of operations in terms of in Payments Bank in June. So that will go through the process. We are looking at a 24-month kind of horizon in terms of going through the entire process.
Right, Ketan, thanks very much. Good speaking with you. Appreciate you joining us. And, I'm sure that we'll be the first to hear if there is some sort of corporate action, etc., takes place with regards to that Capri question. All right, there's a new listing, and every day this week there has been a new listing. I think Keystone Realtors, which is Rustomji, which is making its mark on the exchanges, debut on the exchanges, should come up on your screen. The, I think, bell ringing ceremony is lined up, and we're just counting down 25-30 seconds to the bell ringing. So only one more real estate company for you to track.
Oh, absolutely. And Rustomji, right? I mean, it's a brand that has been par excellence and something that we've sort of all known, and they've had their premium projects. They've done very well. Okay, that's the first gong ringing, and it's such a sweet moment. I mean, look at that, right? I don't know if the ladies, yes.
10, 9, 8, 7.
I think they got their mother or mother-in-law there to ring the gong, and that's a very, very sweet moment.
There you go.
Okay, but I think it's a subdued listing as well. So let's just get the stock up for you. Okay, not bad, not bad. 3% high on Keystone Realtors. One of the name is Keystone Realtors, but Rustomji is something that rings a bell for everyone.
I wonder, why won't you call yourself Rustomji? Maybe there is some thing, right? I mean, it's a... the brand is well known. The brand is Rustomji, but the company under which they're registered is, I guess, Keystone Realtors. So 4.33% higher on Keystone, and we, by the way, have the management joining us a little later to talk to us about the business and how things will look for them. Now, Mitesh is with us to run us through how the market is going to do from here. So, we've crossed yesterday's high, Mitesh, and we are sort of marching away. 80 points now. Any fresh trades, buy into this surge that we are seeing, or wait it out?
Morning again, Prashant. Yesterday we had taken some longs getting past this 18,250 mark. Just trail the stop loss now to today's low, and that is around 18,294. So that becomes your trading stop loss. Somebody wants to buy a fresh, that is the stop loss on the Nifty spot. Having said that, 2 buy calls right now. The oil and gas stocks are doing very well, so I picked up ONGC. That's a buy with a stop just below levels of 136 and a target of around 144 on the upside can be looked at. And NTPC is something which has gone through a big correction, decline from levels of around 180 to about 165 is now reversing. That's a buy as well. Keep a stop below levels of 166.5 and look for a bounce back at about levels of 174.
Okay, well, let's take a quick break on that note. Thanks a lot, Mitesh, for joining in. On the other side of the break, we will speak more about the new listing, Keystone Realtors. Decent listing over there. And the market is picking up pace now. 80 points higher on the Nifty. It's zooming away. But do keep an eye out on the Bank Nifty. It's up over 200 points. So yes, the momentum is picking up. More on that in a bit. Well, the markets are really picking up pace now. So 80 points higher on the Nifty at the high point of trade. Let's see if this lasts, though, because it is going to be volatile, perhaps because of the expiry session, and the US markets are shut later today. But for now, the bulls have it. Let's shift focus to the commodity markets. Manisha is joining in. Manisha, what's the one commodity you're tracking today?
Oh, can't keep my eyes off crude oil prices. The way it has been moving every day, 4% of a decline overnight, and we are now trading at a 2-month lows and not too far away from January lows as well. This is what we've done from the November highs itself. I mean, this is just 20 days of data. And while we did see a high of $91 for the Brent, $91 there, the low clearly has been at 85 is how it's trading. And we also have seen the other crude variety decline from 98.8 to 78. So it has been $12 to $14 of a decline that we have seen from the November highs itself. And the crude prices have been moving anywhere between 3 to 5% on a day-to-day basis here. Well, markets are looking at a weak global demand outlook. The economic data that has come in from various countries has been on the weaker side. That hasn't improved at all. And then the G7 price cap is something that the market was keenly watching for, where the expectation is that you could see a range of $65 to $70 a barrel. And that would be also adjusted periodically, perhaps every quarter or so. But the point being that the 65 to 70 band is much higher, because when you look at the Russian Urals to Northwest Europe, that is selling at 62 to 63. So the cap price is higher than this. Also, Russian Urals being sold to Mediterranean is at around 67 to 68. So there's not too much of a loss that Russia would eventually make. And when you look at the cost of production of the Russian crude oil, that is at $20 a barrel. So Russia is going to be in profit even with those kind of price caps there. What the markets also are looking at in the meanwhile is the December 5th. While it's not just about the price cap that will come in from the G7, but it also is the European Union, which is looking to ban Russian oil exports. So December 5th is going to be quite important. And before that, on December 4th, you have OPEC and allies meeting, deciding about the production going forward. So those 2 days and ahead of that, it's going to be a volatile crude oil prices. Markets also looking at the Chinese COVID cases rising. There's demand weakness from there. And IEA has shown a decline in crude inventories, but a big increase when you look at the gasoline and distillate stocks. So the demand in US also seems to be declining. Everywhere that you see, there is some more pressure expected in case of crude prices.
Okay, all right. Thanks a lot for that, Manisha. Well, let's focus on a couple of stocks that are moving around, and let's go across to Surbhi, who's joining in to tell us about this move we're seeing in sugar stocks. Surbhi?
Sugar stocks are gaining traction in today's trading session, and this is because Indian Sugar Mills Association said yesterday that it is likely to extend the limit of sugar exports by 2 to 4 million tons this sugar season. This move will leave total exports at 8 to 10 million tons. The government earlier this month had already announced the first tranche of sugar exports at 6 million tons. India is likely to produce 36 million tons of sugar and 5 million tons of ethanol. The consumption is around 27 million tons. That leaves a balance of 8.5 to 9 million tons for exports. The mills have already signed contracts to export 4 million tons of sugar.
Okay, so that is stocks in focus. Now, Zomato is the other one which is in focus. Mangalam is here with more on the same. Mangalam, hi.
Well, since morning we've been talking about water and now sugar, so perhaps food could not stay too far behind. And there's an interesting note that has come in on Zomato this morning from Jefferies. They've compared Zomato's metrics with Swiggy because Prosus, which is an investor in the tech, they've made a release and that points to a market share loss for Swiggy. Zomato's market share now for the first half of this calendar year stands at 55%. And that's an important metric to watch out for because, you know, everyone is looking at this market as a duopoly between Zomato and Swiggy. As far as the first half revenues are concerned for Swiggy, the revenues have been 40% higher, whereas the same for Zomato has been 55% higher. And this is purely for the food delivery business. Swiggy's Instamart has done much better. But overall losses for Swiggy in the first half have been $315 million, whereas for Zomato, they've been curtailed just to around $50 million odd. So what does this mean going forward? Jeffrey says that for the near future, they see a possibility of a modest growth in the coming months for the food delivery sector. But, you know, added to that, the losses of Swiggy, it may also mean a strong case for Swiggy actually dropping its aggressive competitive stance in food delivery. And if that was to happen, it would be a big positive for Zomato, because, you know, Zomato from the lows has rallied about 52 odd %. And at the same time, fundamentally as well, the management has been speaking the right things. They've been saying that the food delivery business also turned EBITDA positive in the second quarter. So with all these things, reducing competition could only be a bigger positive.
Okay, thanks a lot for that, Mangalam. That's on Zomato. By the way, the market is looking good. Plenty of stocks moving around. So we'll do one thing. We'll take a quick break. On the other side, we'll be joined by A.K. Tiwari, who's the director at the Petroleum and Natural Gas Regulatory Board.
Welcome back. You know, the market's coming off a little bit, but 88 points, still closer to the high than where markets opened. Look at that. I mean, it's pretty clear the direction so far, 0.4, 0.5% in the green. Now, the Petroleum and Natural Gas Regulatory Board has issued notifications on natural gas pipeline tariff regulations, which became effective the 18th of November. To discuss how these impact the key natural gas players, we are now joined by A.K. Tiwari, member at PNGRB. Mr. Tiwari, good morning. Great to have you with us here. Thank you very much. You know,
Good morning.
good morning, sir. Great to have you with us. In summation, will these sort of changes lead to a higher, better rate of return for pipeline operators? You know, in the note, you talk about a reasonable rate of return, and that got the market very excited. But can you be specific, sir?
Yeah, I will be specific. Thank you very much, and thank you, viewers of the CNBC-TV18. Just to give whether these regulations are going to give more return, I would like to briefly give the perspective behind the regulations. We have come up 4 regulations: capacity regulations, authorization regulations, and most important is the tariff regulations as well as the unified tariff regulations. And these regulations deals with the entity level integration of the capacity and the tariff. There are the many unaccounted things which was there, unaccounted gas losses which was not allowed earlier, as well as adjustment of the volumes throughout the economic life and volume ramp up from 30%, as well as the 5 years moratorium. Tax relief we have also given, as well as the fuel cost on the normative basis. So what I mean to say, these regulations which has come up are going to give boost to the investors as well as the infrastructure developers to take more seriously as well as give more investment. So certainly I will not be able to give any figures for that, but certainly these ramp up which are coming up are certainly going to have better in the profitability as well as the return by the equity. So but one aspect I would like to say that though these ramp up are there, these returns are going to be there plus, but we have also socialized the tariff because we have come up with the 3 zones instead of the 2 zones for the unified tariff, and that is going to socialize the tariff. That means the nearest customer are not going to be impacted, and the farthest customer has to be lesser than the additive tariff charge. So this is it.
Sure. You are not able to give us any numbers, but how often do you think the tariffs could be changed now? And, you know, in the next revision, how much of a tariff cut can be expected?
See, I will not be able to give the numbers because every entities, every GSPL or GAIL or any entities which are there has a different scenario and different volume and everything else. So I will not be able to give any numbers for that. But certainly these are going to have plus on these things. And so far as the revision of the tariff are concerned, as per our regulation, it is 5 years. And once the unified tariff comes, then it will be on year-to-year basis. We are taking the data as well as these things. So this will be there.
Okay, all right. Hi, good morning, Mr. Tiwari. You know, you just spoke about the unified tariff that is likely to be implemented from April 1st, 2023. Now, the draft has got mixed reviews. Some are saying that it will lead to better tariffs for players. Others say not so much. What kind of response have you received?
Yeah, this unified tariff. See, first of all, what we have done, we have come up with the entity level integrations so that we can give boost to the entities that you can go on adding your tariff will be 1. So that is the regulation. Number 2, we have given so many other regulations. In the regulations, we have given so many whatever was not given earlier. So that is also going to give. But in the unified tariff, what it will be better than average tariff. And I would like to share with you that when the regulation came in 2020, our tariff was in the range of less than $1. And this time also we have calculated with the addition of so many other pipelines which has come up and addition of the new pipelines and bid-out pipelines which are there, the tariff will be much less than the $1 unified tariff. So that we have already formed the industry committee and they will work out the settlement mechanism, and it is going to certainly give the boost to the consumer as well as to the entities for further unified tariff implementation.
Okay. Mr. Tiwari, the clause with respect to relaxation of revenue sharing, could you tell us how will this work? Will there be no revenue sharing by the pipelines? What was the idea behind this?
Yeah, this revenue sharing gives the incentive to the pipeline entities who are going to add more capacity addition or whatever the extension they want to have done. Earlier, the regulation was restrictive, and the revenue sharing was there when the extension was done. Ultimately, it was affecting the tariff of the entity. So we have removed this. We have given a free work to the entity that you go on expanding and your tariff will not be cut by revenue sharing also. So that was a deterrent, and that we have removed. And many entities are very happy that they can go on expanding, because as you know that we have expanded these CGD entities all over the country, and investments are required throughout the country. National gas grid are required. So this was deterrent. So we have removed this, and now the entities can express and there will be no revenue cut.
Okay. All right. We will leave it at that. Thanks a lot for joining in. Mr. Tiwari, pleasure hearing from you. That's the word coming in from PNGRB. But let's talk a little bit about the new listing. Keystone Realtors, let's get it up for you on the screen. It's day one on Dalal Street. And the listing was not bad. It was marginally in the green. Now it's up about 2.5%. Popularly known as Rustomjee, the company has debuted today. It was 555 rupees a share was where it listed at. The issue price, remember, was 541. To discuss more on the listing, the business outlook, Baman Irani, the chairman and MD at Keystone Realtors, is with us. Baman, good morning and welcome back on the show. We did speak to you a couple of days ago before the listing. And at that point, I remember you telling us that you're not looking to get out of the Mumbai markets anytime soon. But, you know, now there's so much competition coming through, especially in the affordable segment. Players from down south are increasing their presence in Mumbai. So at some point in time, would you want to geographically expand?
Sonia, first of all, thank you for having me on your show. I would like to begin with, if you don't mind, thanking all our investors and having the confidence in Keystone Realtors, better known, as you said, like Rustomjee in Mumbai and MMR area. You speak about, you know, the size of this market. Sonia, it's one of the largest markets in the country at this moment in time. There are very many good developers already existent out here, and there are plenty of developers who wish to come into this market and, you know, make it a stronghold for themselves. I think this market has ample room for all of us, that is good developers, growing our base out here. More importantly, what we've seen over the last 10 years is that this business has become more and more organized, and we have a lot of larger listed or branded players who continue to grow their market share, whereas the smaller developers and non-organized developers, the market share, at least as far as the customer point of view is concerned, has reduced. This only means that there's a lot more room available for us and all the good competition that comes into the city. This city brings out the best, and MMR brings out the best in most of us, and I wish that the best will continue to grow. Once again, a big thank you to all our investors for putting their faith in us. I promise you, we will work harder. We understand the sense of responsibility that has come upon us, and we will continue to grow in value.
Hi, Baman. Morning. Nigel on this side. You know, it was heartwarming to see that, you know, when the bell was rung and the family members as well were out there. So congratulations on a good listing. But now it gets a little tricky, right? The street looks forward to numbers on a quarterly basis. So it'll be interesting to say the least. The debt in the books, the last reported number we have is around 1,200 crores odd. Could you give us an updated number? And could you tell us, where's this number headed?
So Nigel, thank you for those words. You know, yes, it was indeed a beautiful moment to have the entire family up there and a lot of my team members up there. It's been a 26-year journey where we've been to the school of hard knocks, learned a lot of lessons. We grew a lot with our debt that we took at one point of time till we realized that debt was very good as a short-term friend, not very good in the long run. This year, I think the debt you're talking about, the secured debt that we had on our books was about 901 crores, and we plan to bring it down to 560 crores with the amounts raised through our listing itself. This will allow us to further, because our equity would be in the region of about 1,600 plus crores. We want to maintain a 1:1 debt to equity ratio to maintain it healthy. And this would allow us to continually grow our development in Mumbai and MMR. And as we are all aware that redevelopment has been at the, we at Rustomjee have been doing redevelopment since 2003. And we have very many redevelopments that we've completed, more than 1,400 plus redeveloped homes. And today, this city, it needs a sprucing up. It needs a younger creation of newer buildings, better lifestyle for our residents. And I see the government doing that hugely in terms of the infrastructure that they're building. And it is only our responsibility to keep moving up or sprucing up the buildings that we are building. So with that, with the kind of monies that we've raised, we're looking at putting a lot into growth. And that's our plan for the future. Stay in Mumbai MMR for redevelopments. Stay in Mumbai MMR for joint developments, joint ventures with partners. Rustomjee has been a partnership-driven company. The three of us, Chandresh, Percy and I have been partners for 26 years. Right. And we hope to continue growing more and more partnerships with our landowners, our fellow developers, and etc.
Right. Bowman, good morning. Prashant here. I hope what you say comes true because, your projects and most of these builder projects are islands of tranquility, but you step out and, it seems like a different place, the Mumbai region, MMR, etc. I have two specific questions. One is your profitability. What are margins at right now? And how do you see that kind of tracking from here on? And second is the name itself. Rustomjee is a well-known brand, in this part of the country. So, why not use that as a go-to brand to the market, or are there any limitations to that? Go on.
So, Prashant, if you don't mind my quoting, they say, whatever change begins, it starts from within. And if you want to start cleaning up a city, first start by cleaning up your own home. So that is why when you mentioned that our projects are islands of tranquility, it is to create that very same tranquil space in your home as we go out there into the city and we see a little bit of chaos. It's only time that, we as Mumbaikars and residents of this lovely, beautiful metro realize that we've all got to work towards changing and making this city better. Further, I'd like to just state that Mumbai and MMR will continue to be our mainstay. We will continue to be here. And a testimonial to that is when you see all developers from across the country coming into Mumbai and MMR to make their base. We're just fortunate that we have a market that's so wide and so deep. And there is so much more growth potential out here, especially given the infrastructure initiative taken by the governments itself.
Sorry, margins, Bowman, sorry, we're on the clock. Margins, if you can outline something for us.
Sorry. Yeah. So I will talk about the Rustomjee investment philosophy. We normally do not invest more than 10% of the gross revenues of the project till we are go-to market. When I say go-to market, it means that we are ready for sales. And the time that we try to do this in is in about a year's time of clocking a project in because approvals, etc. are there. And we work on 35% gross margins for most of the projects that we enter in. We enter in a project only if it's got 35% plus gross margins going forward.
Okay, 35% gross margins. Just one final question, since now you have a little more freedom to talk about numbers now that the stock is listed. If you look at the last 4 years, your pre-sales, the annual trajectory has gone up from almost 1,000 crores in FY20. Of course, FY20 was an aberration, but now you're sitting at 2,600 crores at the end of FY22 in terms of pre-sales. How much do you think on an average could the growth be for you, given your launch pipeline?
I'm not sure I'm at liberty to speak about numbers in actuality, but all I can say is that our growth trajectory has been phenomenal, given the COVID, post-COVID buying that took place, and of course the support that came in from the RBI by reducing of interest rates at the same point of time, by the government of Maharashtra by reducing stamp duty, really helped a lot. So this led to a lot of very good buying in the last few years. I think we will continue to grow at probably healthy margins is what I'd like to say. I'm still not sure if I can, Sonia, speak actual numbers, so I'm not sure.
Okay, all right, Baman, it's been good speaking to you. Congratulations on a good listing. Now we could talk more often. You could join us here on CNBC TV18, not just talk about the industry, but talk about your own brand, the listed stock as well. Pleasure talking to you.
Definitely, and thank you very, very much once again.
Well, on that note, though, we'll have to wrap up on this edition of Bazaar. Lots of trading ideas lined up on Chartbusters. Don't go anywhere.